Hello everyone, welcome to today's video presentation about intangible asset presented by Group C and enjoy the video. Let's start with the basic characteristic of intangible asset. Intangible assets have three main characteristics. First, they are identifiable. It means the asset can be separated from the company. For example, sold, transferred, license, rent, or exchange. Or it arises from contractual or legal right, even if it cannot be separated. Second, they lack physical existence. Unlike building or equipment, intangible assets have no physical form. Their value come from the right or privilege granted to the company that use them. And the third, they are not monetary asset. Monetary asset like cash, account receivable, or bond investment give you a right to receive a fixed or determined amount of cash. Intangible assets do not give that kind of claim because intangible assets usually provide benefit over multiple years. They are normally classified as a non-current asset on the statement of financial position. Now let's talk about how to value purchase intangible asset. The general rules is record them at cost. Cost included the purchase price, legal fees, and any other incidental expense, such as registration or consulting fees needed to make the asset ready for its intended use. What if you buy several intangible together or mix by a tangible and intangible asset? This is called a basket purchase. In that case, you allocated the total cost based on the relative fair value for each asset acquired. This is the same approach used to tangible asset in basket purchase. What if the acquired an intangible in exchange for share or other non-cash asset? Then the cost is the fair value of the consideration given or the fair value of the intangible received, whichever is more clearly evident. If both if both fair value are evident, you use the fair value of the consideration given. Evaluating internally created intangible is more complex. The key is to understand the two phases of research and development. First, the research phase. This is the originally and planned investigation to gain new scientific or technical knowledge. Example included laboratory research, searching for application, and conceptual formulation. All research phase costs are expensed as accrued, no exception. Second, the development phase. This is the application of research finding to a plan or design for new or substantially improved production or process. Example included prototype design, testing, and constructed as a pilot plan. And here is the key rules. Development costs are also expensed as accrued until the project achieves economic viability. Once economic viability is achieved, all subsequent development costs are capitalized as an intangible asset. So, what's the economic viability? It means the project is so far enough along the future economic benefit will probably flow to the company. The criteria included technical feasibility, intentional to complete the asset, ability to use or sell it, availability of resource, and the ability to measure cost reliability. Okay, now let's look at the amortization. Intangible assets are divided into two types, limited life and indefinite life. For limited intangible asset, we amortize them over their use life. That is, the period the asset will contribute to cash flow. The amortization method should follow the pattern of consumption. If the pattern can be reliably determined, and if not, use the straight line method. Residual value is assumed to be zero unless another party will buy the asset at the end of its life, and the fair value is reliably determinable. You must review the useful life and residual value at least annually. If the useful life change, amortize the carrying amount over the revised remaining life. Finally, the impairment test is performed only if there is an indication of impairment. And for the life, indefinite life intangibles, there is no amortization because there is no forcible limit on the period over which the asset will generate cash flow. Common example included trademark that are renewable at nominal cost and long-standing brand names. Because they are not amortized, they must be tested in impairment at least annually. This is more stringent requirement. The impairment test compare the carrying amount to the recoverable amount, which is the higher of fair value less cost to sell or value in use. Okay, this is the summarize of the accounting treatment for intangible asset in a simple table. Look at the manner accurate for purchase intangible, both limited life and indefinite life asset are capitalized at cost, and for internally created intangible, the general rules is to expense them, except for the certain limited costs that meet recognized criteria. Those are the development costs capitalized after economic viability. Now, amortization. Limited life intangible are amortized over their useful life. Indefinite life intangible are not amortized. And finally, impairment testing. For both types, we compare them recoverable amount to the carrying value. If the carrying value if the carrying value exceed exceed the recoverably or more than recoverable amount, an impairment loss is recognized. In this table, you can see it quickly and know it better.
So I will explain about the type of intangible assets. So there are many different types of intangible, often classified into the following 6 major categories. First is marketing-related intangible asset. Second is customer-related intangible asset. Third is artistic-related intangible asset. 4 is contract-related intangible asset. And 5 technology-related intangible assets. And the sixth is goodwill, but I will not explain that because my friend will explain that. So first, in this slide, I will explain about marketing-related intangible assets and customer-related intangible asset. So Marketing-related intangible assets is company primarily use a marketing-related intangible asset in the marketing promotion of their product or service. For example, are like a trademark or trade name, newspaper masthead, internet domain names, and non-competition agreements. A trademark or trade name is a word, phrase, or a symbol that distinguishes or identifies a particular company or product. Trade name like Mercedes-Benz, Pepsi-Cola, Honda, Cadbury, X, Wheaties, and IKEA create immediate product identification in our mind, thereby enhancing marketability. So a recent expansion of internet domain names will allow interested to use terms like cars or even web slang like LOL. This expansion has led to a new wave of domain name activity. For a substantial fee, company can register their own domain names. Application receive included company names such as Sony Japan, which will have the name Sony. So, and for city-based domains such as NEC for New York and Berlin for Germany or Berlin. So, under common law, the right to use a trademark or trade name, whether registered or not, rests exclusively with the original user as long as the original user continues to use it. For example, in the United States, registration with the U.S. Patent and Trademark Office provides legal protection for an indefinite number of renewals for periods of 10 years each. Therefore, a company that uses an established trademark or trade name may probably consider it to have of an indefinite life and does not amortize its cost. If a company buys a trademark or trade name, it capitalizes the cost of the purchase price. If a company develops a trademark or trade name, it capitalizes costs related to securing it, such as attorney fee, registration fee, design costs, and consulting fee. However, it excludes research costs and development costs that do not meet recognition criteria. So when the total cost of a trademark or trade name is insignificant, a company simply just expenses it. So it is not uncommon for companies to incur legal fee and other costs to protect their valuable trade names and other intangible assets. So in general, IFRS does not allow capitalization of the subsequent in expenditure. So why it is, the IASB indicates that subsequent expenditure likely only maintain the expected future economic benefit of the existing intangible asset rather than enhancing its value or creating a new intangible asset. The second intangible asset is customer-related intangible asset. So customer-related intangible asset is result from interaction with outside party. For example, it's like a customer list or production backlogs and both contractual and non-contractual customer relationship. So to illustrate, it's like this. So assume that Green Market AG requires the customer list of a large newspaper for 6 million euro on January 1, 2022. So this customer database includes names, contact detail, order history, and demographic information. Green Market expects to benefit from the information evenly over a 3-year period. In this case, the customer list is a limited life intangible that Green Market should amortize on a straight line basis. So Green Market records the purchase of the customer list and the amortization of the customer list at the end of years as follows, like the first picture that I saw. And then the preceding example assume no residual value for the customer list. But what if the Green Market determines that it can sell the list for 16,000 euro to another company at the end of the 3 years? So in that case, Green Market should subtract this residual value from the cost in order to determine the amortization expense for each year. So amortization expense would be 1,918,000 euro per year, as shown in the next pictures. So company should assume a zero residual value unless the asset useful life is less than the economic life and reliable evidence is available concerning the residual value. Okay, let's move to the next slide. So in this slide of The type of intangible asset I will explain about. First, artistic related intangible asset. So artistic related intangible assets involve ownership, right to plays, literary works, musical pictures, photograph, and a video and audiovisual materials. Copyrights protect this ownership right. So a copyright is a government-granted right that all authors, painters, musicians, sculptors, and other artists have in their creation and expression. So a copyright is granted for the life of the creator plus 70 years. So it gives the owner or heirs the exclusive right to reproduce and sell an artistic or published work. So copyrights are not renewable. So copyrights can be valuable. In the late 19th, Disney USA faced the loss of copyrights on Mickey Mouse, which could have affected sales of billions of dollars of Mickey-related goods and services, including the theme park. So this copyright was so important that Disney and many other big entertainment companies fought all the way to the U.S. Supreme Court and won an extension of copyright life from 15 to 17 years. So company capitalize the cost of acquiring of a copyright. So they amortize any capitalized cost over the useful life of the copyright if less than its legal life. Legal life is life of the creator plus 70 years. So for example, really useful group should allocate the cost of its copyright to years in which it expects to receive the benefits. So the difficulty of determining the number of years over which it will receive benefits typically encourage a company like really useful group to write off this cost over a fairly short of periods of time. The company must expense all research costs and any development costs not meeting recognition criteria that lead to copyright as those costs are incurred. So the next intangible asset types is contract-related intangible asset. So contract-related intangible assets represent the value of rights that arise from contractual arrangement. So for example, it's like a franchise and licensing agreements, construction permits, broadcast right, and service or supply contract. So a franchise is a contractual agreement under which the franchisor grants the franchise the right to sell certain products or service, to use certain trademark or trade names, or to perform certain function, usually within a designated geographical area. So when you purchase a Prius from Toyota Japan dealer, fill up your tank at the corner Shell NLT station, or eat lunch at McDonald's in the USA restaurant. So you are most likely dealing with the franchises. So the franchisor, having developed a unique concept or product, protect its concept or product through a patent, copyright, or trademark or trade name. So the franchise acquires the right to exploit the franchisor idea or product by signing the franchise agreement. Another type of franchise agreement granted by governmental body permits a business to use a public property in performing its service. For example, the use of city street for a business line or a taxi service. The second is the use of public land for telephone, electric, or cable television lines, and the use of airwave for the radio or TV broadcasting, such as a bragging rights are referred to as license or permits. Franchise and license may be for a definite period of time. For an indefinite period of time or perpetual, the company securing the franchise or license carries an intangible asset account where it can interpolate a franchise or license on its books only when it can identify costs with the acquisition of the operating right, such as costs might be a legal fee or an advance lump sum payment, like for example. So a company should amortize the cost of franchise or license with a limited life as operating expense over the life of the franchise. It should not amortize a franchise with an indefinite life nor a perpetual franchise. So the company should instead carry such a franchise at cost. Annual payments made under a franchise agreement should be entered as operating expense in the period in which they are incurred. This payment does not represent an asset since they do not relate to voter rights or use the property. So let's move to the next slide. The last one, I will explain about technology-related intangible asset. So technology-related intangible asset is related to innovation or technological advance. For example, it's like a patented technology and trade secret granted by a governmental body. So in many countries, a patent gives the holder exclusive right to use, manufacture, and sell a product or process for a period of 20 years without interference or confringement by others. Companies such as Merck in the USA and Canon in Japan were founded on patents and built on the exclusive right thus granted. The two principal kinds of patent are product patent, which cover actual physical product, and process patent, which govern the process of making the products. And then amortization expense should reflect the pattern. If reliably determined in which a company used up the patent, a company may credit amortization of patent directly to the patent account or to uncredit amortization of patent accumulated patent amortization account. So to illustrate, assume that Hercotco incurs $118,000 in legal costs on January 1, 2022 to secure a patent. So the patent useful life is 10 years. Amortized on a strict line basis, Harcourt records the legal fee and the amortization at the end of 2022 as a follow. Like you can see, so in the record of legal fee to patent in January 1, 2022, the debit is patent, the credit is cash, which is $118,000 per each debit side and credit side. And then to record the amortization of patent in the December 31 and 2022, so the debit side is a patent amortization expense, which is just $18 because 118,000 divided by 10. And then for the credit side is a patent or accumulated patent amortizations. So we indicated that a patent useful life should not extend beyond its legal of 20 years. However, companies often make a small modification or addition that lead to a new patent. So for example, it's like AstraZeneca Putri GBR. So file for additional patent on a minor modification to its heartburn drug Prelox. So the effect may be to extend the life of the old patent. If the new patent provides essentially the same benefit, AstraZeneca can apply the unamortized cost of the old patent to the new patent. Alternatively, if a patent becomes impaired because demand drops for the products, the asset should be written down or written off immediately to expense. So the last intangible assets is actually a goodwill. But goodwill will be explained by my friends in the next slide. Thank you.
So now we're going to talk about goodwill. Goodwill is conceptually represent the future economic benefit arising from the other assets acquired in business combination that are not individually identified and separately recognized, and only recorded when an entire business is purchased. Goodwill is measured as the excess of cost over the fair value of the identifiable net asset or asset less liability acquired. Goodwill exists when the amount of purchase is higher than fair value, and the opposite goodwill is gain on acquisition, and it happens when the amount of purchase is lower than fair value. And recording goodwill write-off. When goodwill considered to have an indefinite life, should not be amortized and only adjust carrying value when goodwill is impaired. And break-in purchase is purchase price less than the fair value of net assets acquired, and the amount is recorded as a gain by the purchases or the gain on acquisition.
Of limited life intangible is the rules that apply to impairment of property, plant, and equipment also apply to limited life intangible. So just like in chapter 11, we also talk about impairment, that which is happen if the carrying amount is more higher than the recoverable amount. And the example is like large SA has a patent on how to extract oil from salt rock with a carrying value of 5 million euro at the end of 2021. Unfortunately, several recent non-salt oil discovered adversely affected the demand for shale oils technology indicated that the patent is impaired, so the large determine the recoverable amount for the patent based on the value in use because there is no active market for the patent. Estimated the patent value is at 2 million based on the discount expected net future cash flow at its market of interest. So just like here, the current value is in 5 million, and then the value in use or the recoverable amount is in 2 million, so there is an impairment. So the how to calculate the impairment is by minus the 5 million with this 2 million, and there is a loss of impairment 3 millions. And then to record in journal, we put loss on impairment in credit for 3 millions and patent on credit, on impairment for debit in 3 million, and patents in credit for 3 millions too. And then reversal of impairment loss. So this is like if there is a higher value of the product or the intangible asset, there is a reversal right. So they assume that the remaining life of the patent, the before patent has been shared, is 5 years with the zero real value. Recalling the carrying value of the patent after impairment is 2 million, which is from 5 million minus 3 millions. Those left amortized for 100,000, which is we divided the carrying value of the patent after impairment, which is in 2 million, divided with the remaining life, which is 5, so we will get 400,000 euro. Over the remaining 5 years of the patent life, the amortization expense related carrying amount after the impairment are okay. So here at the screen you can see from 2022 the amortized will be 400,000. So the carrying amount, which is 2 million minus with the 400,000, so the carrying amount less is in 1,600,000, and it become decreasing with the 400 until the 5 years, which is in 2026, and the carrying amount becomes zero. How to recorded is from patents in 150,000 on debit, and then the recoverable amounts in 150,000 too. So the carrying amount is now at 1,750,000, which is from 1,600,000 plus with the 150,000, with estimated remaining life is 4 years. So let's record will be 437,500, which is get it from 1,750 divided by 4 of, and become the amortized expense in 2023. Life intangible other than the goodwill. So it should be tested impairment annually. So the test for the limited life intangible, just one, compare the recoverable amount of the intangible asset with the asset carrying value, and also if the recoverable amount less than carrying amount, the company will recognize it as impairment. So examples like Aaron Radio purchased a broadcast license for 2 million euro. The license is renewable every 10 years. If the company provides inappropriate service and does not violate Government Communication Commission, which is GCC rules, Arcon Ready has renewed the license with the GCC twice at the minimum cost because it expects cash flow to less indefinitely. Arcon reports the license of infinite life intangible asset. Recently, the GCC decided to auction this license to the highest bidder instead of the renewing them. Based on the recent auction of similar license, Arcon Ready estimate the value less cost to sell, which is the recoverable amount of its license, to be 1,050,000. So the impairment will be conduct or will be carried from minusing the 2 million with the 1,500,000. So we have a loss of environment in 500,000. And for the recording, just like the same, we have environment of goodwills, so conducted based on the cash generating unit to which the goodwill is assigned, and the cash generated unit is the smallest identified group of assets that generate cash flow. The estimation of trade recoverable amount for goodwill environment is usually based on the value in use estimated. So there is basically using only the value in use, not value in sale. So goodwill environment loss reversal are not permitted, so there is no reversal. As a policy like Kolbu AG has 3 divisions. It purchased 1 division, paid products for years ago for 2 billion, and unfortunately, paid experienced operation losses over the last 3 quarters. So the Kolbu management is now reviewing the division, which is the gas generating unit, for purpose of its annual environment testing. This pre-division net asset including associated goodwill of 900,000 from the purchases. So we need to total the asset, which is they have property, plant, and equipment for 800, and then goodwill for 900, and inventory 700, receivable 300, cash 200, and there is account and notes payable for 500,000. So the net asset would be 2,040,000. After that, the carrying value of Colby per division is in 200 for 2,040,400,000, right? So the recoverable amount of the per division is in 1,900,000. So to calculate the impairment, just minus the 2,040,000 with the 1,019,000. So we have the loss on impairment for 500,000. To calculate it, is a loss on impairment, which is 500,000, with the goodwill on the credit 500,000. To following this entry, the carrying value is in the amount. And also presentation, we continue to presentation of intangible asset. So this report as a separate item on intangible asset other than goodwill. So this is a separating item on intangible asset other than goodwill. Is similarly reporting is just same or similar with the property, plant, and equipment. The contract account are not normally shown for the intangible. And also in income statement, it's reported 1 amortization expense and 2 impairment losses and reversal for intangible asset or the goodwill separately in net income. And notes for financial statement should include the amortization expense for each of asset.
Next, we will discuss about research and development costs. So, research and development costs refers to activities conducted by companies or organizations to create new products, improve existing products, or develop new technologies and processes. And R&D is important because it helps company to increase innovation, improve competitiveness, and create better products and services, also to support long-term business growth. And research activities uh, refers to original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. The example is when laboratory research aimed at discovery or of new knowledge, searching for application of new research findings. And then development activities refers to application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes, system, or services before the start of commercial production or use. The example is conceptual formulation and design of possible products or process alternatives, construction of prototypes, and operation of pilot plants. Next is accounting for R&D activities, the costs associated with R&D activities, and the accounting treatments accorded them are as follows. First is materials, equipment, and facilities. The expense, the entire cost unless the items have alternative feature uses in other projects or otherwise. If there are alternative feature uses, carry the items as inventory and allocate as consumed or capitalize and depreciate as used. Next is the second one is personnels. The expense as incurred as salaries, wages, and others related costs of personnel engaged in R&D. And then third one is purchase intangible, recognized and measured at fair value after initial recognition, account for in accordance with their nature as either limited life or indefinite life intangible. The fourth one is contract services. Expense the cost of services performed by others in connection with R&D as incurred. And the last one is indirect costs. Include the reasonable allocation of indirect costs in R&D costs, except for general and administrative costs, which must be clearly related in other to be included in R&D. And the next is cost similar to R&D costs. Many costs have characteristics similar to research and development costs. The example are startup costs. So startup costs are incurred for one-time activities to start a new operation. Startup costs include organizational costs such as legal and governmental fees incurred to organize new business entities. The accounting for startup costs is straightforward. Expense startup costs as incurred. And then the next one is initial operating losses. Initial operating losses are losses experienced by a company during the early stage of business operation or when introducing a new product, project, branch, or system. These losses usually occur because revenue are still low while operational expenses are already high. And then the third one is advertising costs. Advertising costs are expenses incurred by a company to promote its products, services, or brand to the public. The main purpose of advertising is to increase customer awareness, attract potential buyers, improve sales performance. Advertising activities can be conducted through various media such as television, social media, newspaper, billboards, website, and digital platform.
Thank you for watching this presentation video, and we apologize if there are any mistake in the video, and I hope this video can be useful for all of you, the audience or the viewers, and thank you. Bye bye.